day here in DC. Ice is melting. I actually went outside, and despite it being in the mid 40s, it felt like spring. So just shows you the benefit when you have single degree temperatures, I guess, for extended weeks, as even 40 degrees feels warm to you. So it's a nice perk. But I'm happy to be hosting this today. Had a lot of help from the team in putting this webinar together. So really excited to be sharing it with you. I'm just going to wait for a second here to make sure everyone gets in, and then we'll go ahead and jump into presentation. And we have a couple polls that we're going to launch for you all to answer so we can get a better sense as to where you guys stand on some of these things. And then as a quick housekeeping item, in the bottom of your screen, you should see a Q&A button that you can press, and you can type in specific questions that you have, and we will answer them. And if there's something that requires follow-up, we can send you an email to follow up as well. All right, if everyone can hear me and see my screen, if you could give me kind of a thumbs up, or maybe even raise your hand, then I know we're good to go. Thank you. Perfect. All right, I think we're good. So I'm going to go ahead and share my screen. Hopefully everyone can see this here. So what we're talking about here is mutual fund distributions, which is a common source of confusion from clients, and for good reason. It is not a very intuitive thing, and it's something that's misunderstood. So it's really important that we go over it. So I'm happy we're doing it. So we're going to talk about some different definitions as it relates to mutual fund distributions, taxes from these distributions. When is it taxed? When is it not? What the NAV is, or net asset value, distribution and corresponding drops in mutual fund price, some different investment strategies, and then some common misconceptions that we want to cover. This is our team. We've had some questions about who's on the team now, and so we just want to make sure myself, Jeff, and Jen, obviously, as the founding partners, and then within the last 6 months we added Will Baronato and Alex Beloga. So it's we have a 5-person team now. Will and Alex both just passed their Series 65 exam, which allows them to provide advice, investment advice. Both Alex and Will have been, really helpful to the team and providing really good support, and we've had a lot of positive feedback from clients. You may get calls from them and scheduling reviews, or when you call in, they're answering the phone. Jen, Jeff, and I are still here. We just have, they're just a part of the team now. So if you hear an unfamiliar voice, it's probably Alex and Will, and they'd be more than happy to answer any questions you have or get you to the right member of the team. So let's start with, what is a mutual fund? Okay, what is a mutual fund? Because there's so many different investments that are out there. Most of the time when retail investors are talking, they're talking about individual stocks, right? But a mutual fund is still, I believe, the most common way that retail investors are getting exposure to the markets. And a mutual fund is a fund or a company that pools money from hundreds, if not thousands, tens of thousands of investors. And that all goes into one pool. And then that mutual fund will buy securities, which are either stocks or bonds. There could be other things, but those are the two most common. And what determines what types of stocks or bonds they buy, or whether they're buying stocks or bonds, is what the mandate is for that fund. There are some funds that are balanced funds, which buy stocks and bonds with the idea of providing some stability, but still capital appreciation over time. There are other mutual funds that just buy stocks. There's some that buy only international stocks, some that buy just US stocks. Maybe it's small US stocks, growth, value, US bonds, international bonds. There's thousands of mutual funds, frankly. Some of the biggest providers are the Fidelities, the Vanguards, the JP Morgans, the Schwabs. And those are kind of the biggest I would say, mutual fund providers out there. And then there's other pooled investment vehicles. So there's exchange traded funds, there's REITs or real estate investment trusts, and then hedge funds. Hedge funds are less common. Those are typically only accessed with very large sums of money. They can do some really exotic and eclectic things. So how do you make money in a mutual fund? Well, there's really two ways. One is distributions the mutual fund sends you. And then two is selling the shares of a mutual fund, right? Or incurring a capital gain from buying the mutual fund here and selling it here. And who is making these decisions, right? So the portfolio manager is really the most important part of any mutual fund, because that's the person or persons who are deciding which stocks or bonds to buy, when to buy them, and when to sell them and buy something else. And so active mutual funds, active portfolio managers can add a lot of value in some cases over long periods of time by avoiding stocks that are overly expensive or are in secular decline, and purchasing securities that might be out of favor, but still have really good fundamentals. And that's certainly kind of what we look for in a portfolio manager. So big picture, a mutual fund is a fund that pools money, right, for many, many investors. So it all comes in as one pool, and then they're buying the stocks or bonds with that pool. And each of those investors gets a corresponding number of shares of that fund based on how big, how big of an investment they've made in the fund, how many dollars they put in. So the three sources of distributions at the fund level, right? One is capital gains and losses. So, well, first, what we need to define here is what's called kind of the cost basis, which is the purchase price of an investment and includes, right, reinvested dividends. So dividends that come out and get reinvested, you pay tax on that. That's part of your cost basis. And then a capital gain is the profit, right? What you sold it for minus what you paid for it. That's considered to be the profit, or the capital gain. So the old adage, buy low, sell high, right? That's how gains are generated. It's also known as capital appreciation, right? The money going up. Second kind of category is dividends, right? Many stocks, not all, but many pay dividends. It's generally on a quarterly basis. Generally, companies that pay dividends, it means they have leftover earnings. Okay, so they have money that's left over that they don't reinvest back into the business, and they pay it out to you as a shareholder. All right, and that's more typical of value stocks than it is growth stocks. But even Apple, right, as an example, more of a growth stock, I'd say, although it's being recategorized as value, that pays a dividend. And then interest is a cash payment from a bond, right? Or even, it's not really in funds, but if you own a CD, that pays you interest, right? That interest is going to be taxable to you in the form of a bond. It's generally paid twice a year, and that's known as a coupon. So mutual funds can distribute all of these, right? And it generally falls under kind of two categories of income. One is the umbrella of dividends, which is dividends and interest, okay? And then capital gains, which are capital gain distributions. So even though you might have a bond mutual fund is invested in bonds that are paying that fund, interest is accumulating. When the fund pays it out to you, it's paid out as a dividend, okay? But even though the source of that is actually interest. So mutual fund distributions, this is obviously, some of you may know, but this is David Giroux from Capital Appreciation. He's a core holding across almost all of our client accounts. But mutual fund distributions, as I said, they come from these two different categories. One is dividends, right? So that's income from the portfolio. So it'd be dividends from stocks or interest from bonds. And then the second one's a little bit trickier to understand. It's capital gains distributions, right? So it's capital appreciation, right? So a stock that the fund has bought went up in value, and then the portfolio manager has sold that stock. Well, that's a realized capital gain. And for a mutual fund to keep its kind of tax exempt status, it's got to distribute or pass through those realized gains or losses, frankly, through to you as the investor or the shareholder. Those trades are at the discretion of the portfolio manager. So they're only going, should only be making those buys and sells when they believe that the after-tax investment impact of doing so is going to put the shareholder at an advantage, right? So it's this age-old principle: buy low, sell high. All right, so now we're going to pivot to a poll. I'm going to read it to you first, and then I'll put up the poll. When considering these mutual fund distributions, what matters most to you? Tax efficiency, income generation, total return potential, or portfolio diversification? So give me a sec here. All right, so go ahead and take some time to answer this question. You can only answer one. Good. Good. All right, almost everyone's answered. Okay. It's okay if you don't answer, but almost everyone's answered. So I'll go ahead. So 7% mentioned tax efficiency, 13% mentioned income generation, 67% answered total return potential, and 13% answered portfolio diversification. So good job. I think it really does depend, but I do think what you most want to think about with these distributions is the total return potential. Okay. So let me go back into the presentation here. So this was number 3 was the one that was answered by most people, and I think that was the right answer. So now let's talk a little bit about how these different distributions are taxed. And I don't want you to focus so much on the tax amount that this is saying, as much as what's kind of the least efficient from a tax perspective and what's the most efficient. So interest in general is not very tax efficient because it's taxed at your marginal tax rate, which right now for the federal side, 37%, could be more than that net interest investment tax. And then you also have the state. So it could be over 40%. The exception to that would be municipal bond interest, which is tax exempt at a federal level and possibly at the state level if you buy municipal bonds in the state where you live. Dividends, it depends. If it's a qualified dividend, that's going to be taxed as your long-term capital gain rates, which is generally be 0, 15, or 20%. For capital gains, if the fund has held that stock for more than a year and then sold it, you'll get taxed that same 0, 15, or 20%. But if they sell it in less than a year, it'll be taxed the same way that interest is taxed. And if you're getting your return of capital, obviously, none of it's taxable, right? So if you think about, you save money from your paycheck, you put it into a savings account, you get to $50,000, you take out the $50,000 to buy a car, you don't get taxed on that $50,000. You've already paid tax on it. You might be taxed on the interest, but not the $50,000 you put in because that was an after-tax contribution. Okay. So a couple of things to make sure you understand. Tax implications really depend on the type of account. If you have a 401k, TSP, 403b, IRA, Roth IRA, all these things can be happening under the hood of those accounts, but you're never going to get a 1099 for it because it's in a tax deferred or tax exempt account. The only time you're taxed on that money is when you withdraw it out of that account, and then it will show up as a 1099-R. Okay, and remember, we have to wait until 59.5 to access those funds, right, to avoid 10% penalty. What we're talking about here, really, where you're seeing the tax impact, is in the brokerage accounts, right? That's a joint account, an individual account, tenants by entirety. It's money that you invest after you've already paid taxes on it and doesn't have any special tax treatment. So we talked about before, but qualified capital gains are taxed as taxed at advantageous rates, 0%, 15%, or 20%. And then if it's a non-qualified or short-term capital gain or non-qualified dividend like a REIT, or just interest that's paid, it's taxed as ordinary income. Okay, and that can be as low as 10 or as high as 37%, but it's generally going to be a lot higher than the capital gain rate. Okay, now let's get into some of the kind of mechanics of how a mutual fund works and some terminology. So there's something called the NAV, the NAV or the NAV of a mutual fund, and that's just a short abbreviation for the net asset value of the fund. So if you were to take all of the fund's assets, right, all the money investors have put in, plus any gains, minus any expenses or liabilities that were owed, and then you divide that by all the outstanding shares, you get the price per share of the mutual fund, right? The price per share of that mutual fund. And that's calculated only once a day. So unlike stocks that trade throughout the day, a mutual fund, if you buy in, you're going to get the price at the end of that day. And if you sell, you'll get the price at the end of the day. So what drives that net asset value, right? What drives that price per share? Well, one is obviously what's happening with the underlying securities that the fund owns, right? If the fund for the last, let's say, the fund was started 10 years ago, it's owned only tech stocks. Well, that fund's market price is going to be dramatically higher today than it was 10 years ago, right? What's driving the net asset value up is the capital appreciation of the stocks that the fund owns. In addition, the net asset value can accumulate right at the fund level within the fund, dividends that come in from stocks it owns, interest, and capital gains. Now, for a mutual fund to maintain a very efficient tax status, it is required to distribute almost all, of those dividends, interest, and capital gains that accrues over the year to you as the shareholder each year in order to not be taxed at the mutual fund level. It's got to pass those things through to you. And that's what creates this confusion from so many clients on understanding, well, wait a minute, put this into it. The price just dropped. I'm seeing a drop of 8%. The market, didn't even go down. Why is this? We get those emails every year. It's generally in December where they'll see a fund they own. Why did this fund drop 8%? What happened? Well, it didn't. Yet the price per share dropped 8%, but you didn't drop 8% because it paid out a distribution that equaled 8% of the fund. And then you could either decide you wanted to reinvest that, which is going to increase your cost basis, right? Or take it as cash. But if you're just looking at like you would look at a stock with a mutual fund, it's misleading. It's misleading because a mutual fund is going to pay out generally much bigger distributions than owning individual stock. And if you give me $100 and I give you back 10, well, you have 90 with me at the mutual fund level and 10, you still have $100, right? But if you just looked on your fidelity.com site, it's going to show a negative 10% for that fund because it's not going to capture in that performance the $10 that was paid out to you. And that's where people get super confused. So what are the impact of when these distributions occur? The net asset value drops by exactly the value of the distribution. So if the NAV is $20 per share and it pays out $2 per share, right? You're going to see $18 per share on that fund, which is going to, and Fidelity is going to show negative 10% on that day. But if you look in your activity, you'll also see $2 per share that was paid out to you. And then that could be either reinvested or kept in cash. Generally, we reinvest it, right? So why? So the net asset value represents the value of the fund, dividends, interest, capital gains, right? Those accumulate throughout the year. And then to keep their tax exempt status, they have to pay out those distributions to you as the client or shareholder. You can either reinvest or take the cash. So if the initial net asset value is $10 a share, distributed $1 per share, well, after that distribution, it's going to show that your fund has it's at $9 per share, because, right, you add up 9 plus 1 and it's 10. So, sometimes this is frustrating because you have to pay taxes on this dollar that was sent to you, even though you're not taking the money. You want to reinvest it. And what I try to say to people is, yes, we do have to keep in mind tax efficiency, but we never want to let the tax tail wag the investment dog. We don't want to not make an investment decision to sell something because we don't want to pay the taxes on it, right? If we feel like a stock is overvalued or management's not doing the right thing, and this is the portfolio manager generally making these decisions, he doesn't want to just hold on to it because he's worried, oh, there's a big gain and everyone's going to pay taxes. No, he's going to sell it because he thinks it could go down in value, takes the profit and puts it into something where he feels like the risk reward is better. And that's what you want. So what should I focus on instead of the net asset value? The answer is your total return, right? It's how much has the net asset value gone up and how much has it sent out in distributions, right? That's a much more holistic approach to investing. It helps you maintain a longer time horizon versus if you're looking at any given day, the net asset value could fluctuate wildly. And that could be something totally unrelated to market performance. It could just be related to that a distribution took place. And generally, if you see a large decline, the first question is, did a distribution just occur? And normally the answer is yes, right? But if we're logging into fidelity.com, and I know we've talked about not doing this, but I know many clients can't help themselves, so we want to address this, is you have to be really careful looking at that, for mutual funds, the net asset value and whether it's up or down, because that's not telling the full picture for your investment in that fund at all. We review performance reports with our clients, a minimum of once a year, and that does show the total return. It's going to capture both the appreciation and the distributions. And if you ever have a question on a particular fund, we can show you, here's what you put in, here's what the fund has distributed out, and here's what the current value is that you have in that fund. And that's going to be a much better way to determine your actual return. All right, so let's do another quick poll. I like the polls. How do distribution drops make you feel? Indifferent, slightly anxious, curious to learn more, or I had no clue my net asset value dropped each year, which is an okay answer as well. Let me launch this. Go ahead and answer that one. Okay, almost all of them in. No one has answered slightly anxious yet. So we obviously have people attending the webinar who have already understand this issue. But in reality, what I do get is more of a slightly anxious, at least the people who reach out. So looks like most of the people who've answered are going to answer. So I'll end the poll. I'll share the results. So it was really people who are either completely calm, doesn't bother them, or curious to learn more, which is great. So let me go back here. I know we have a question in the queue. Bottom line is people who are calm or indifferent, curious to learn more. If you're calm or indifferent, it probably means you understand what's happening. You have some experience with this, and that's great. And if you're curious to learn more, that's great too, because it means you have a growth mindset and You want to understand. And it's also okay to be a little anxious or to have say that you have no clue, because the whole point of having a wealth management team is so that you don't have to worry about this stuff. You can kind of check in with us and hold us accountable. So any of these answers would be fine, but I'm happy to hear most people were fine or just curious to learn more, which is why they're here. So distribution investment strategies, right? So, okay, you have two choices. The mutual fund makes a distribution based on activity for the year. It can either be reinvested, all right, or you can take the cash and not reinvest it, right? So if you reinvest it, your cost basis is going to go up because you're paying taxes on the amount that's distributed. Okay. So, and also your number of shares increased because you have your original shares plus the new shares purchased with the reinvestment. So if you're looking at it from a dollar standpoint, if you bought in for 1,000, 100 was sent out to you, and then you reinvested it. Well, now your new cost basis is 1,100 because that's all the money you've paid taxes on already, right? Whereas if you just took the cash and didn't reinvest, your number of shares are going to remain the same. You'll pay taxes on whatever was paid out, and the taxes you pay out will depend, was it all long-term capital gains? Was it some dividends and interest? You know, whatever that breakup is going to drive how much tax liability you owe. But generally with the funds we have, we default to reinvesting it. Okay, we default to reinvesting it so that compounding effect can take place. I think a good example of that, this is not a mutual fund. This is just the S&P 500 total returns going back from 2000 to 2020. And what's interesting that I think is important noting is the kind of the tan here is showing just the change in price of the S&P 500, just the price. So if you were to look at if you had a S&P 500 mutual fund, and you were just looking at the change in NAV, you would see this tan gold. But if you also factored in the dividends that were paid and reinvested along the way, your return would be significantly higher. About 40% of the total return of the market over that time frame was from the dividends, and the dividends being reinvested. So the dividends matter. You have to factor that in as well. So I think this is a great slide about common misconceptions, right? The distribution drop. So this is the top pieces here are all incorrect conclusions, but many people have them because of the way it's shown on their custodian website like Fidelity or Schwab. My net asset value went down. I must have lost money in my portfolio. Actually, your total return hasn't changed. The net asset value decreased by the same amount as the distribution that was sent to you, right? And you will see that in your account under activity if you look. And then timing the market. Well, I got my distribution, but the market's going down. I'm going to wait and try to time the purchase of the new shares. It's almost impossible to time the market, right? So having things default or auto set to reinvest is generally a much better strategy, especially when the market's going down, because you're buying shares at lower prices. And then taxes. I immediately reinvested my distribution. And this has happened a lot. I didn't take any money from the portfolio. Why am I getting a tax bill? Well, because it doesn't matter whether you reinvest or take the cash, right? The distributions are always going to be taxable in a brokerage account in that year that distribution occurred, whether or not you take it. And so that is something to be mindful of, right? We don't want to have mutual funds in brokerage accounts that are really tax inefficient, because that is going to be a drag on the return and could cause some tax issues for some clients. I see we have 2 questions in the queue. That's great. This is actually the last slide here. Then obviously our disclosures. So I know this was I knew this would be a little bit shorter than usual because there's only a very kind of narrow topic, but we wanted to make sure we covered it. So let me thank you all for attending. Let me see what the Q&A is here, and then let's see. Does tax treatment depend on whether it's an open-end or closed-end mutual funds? So open-end mutual funds is what we're talking about here, which is basically where, right, it's not traded on an exchange. With a closed-end fund, it's traded on an exchange. And so other than like distributions that are being sent out, like interest that a closed-end fund is generated, it's going to be more like how an individual stock would be. So all we're talking about here is open-end funds. We don't own any closed-end mutual funds. Let me see where those questions went. So in terms of efficiency of different funds, an exchange traded fund is definitely more efficient than an open-ended fund, because an exchange traded fund it's like a quirk in the tax code, where even when things are bought and sold, they're like, it's a little beyond me, but they're exchanged. And so it's not considered a taxable event in that year. So it's frankly a pretty weird quirk how that can happen. But yeah, if you have an active fund that's in an ETF form, it's going to be more tax efficient than a mutual fund. Now, those capital gains are just getting deferred out, so eventually they will be paid, but it is more efficient. Yes, index funds are going to be the most tax efficient in general because there's no active management. So you're going to get the dividends that are paid out because the stocks generate dividends, but because it's a index fund you're buying, it's basically just owning these companies, and then whatever they do up or down, it just holds them. Okay. Yes, we're happy to send these slides to you. That was another question. We could definitely do that. Any other questions? That was it. Oh, one more. When does a long-term strategy start to shorten? Can you clarify your question, Tim? I'm not, like, what context are you asking? When does a long-term strategy start to shorten? I think, I guess I could I know you're clarifying probably, but I think you could interpret that as like, if you're at retirement and you historically had always reinvested the distributions, maybe now you have it not set to not reinvest, accumulating cash for the next year's worth of spending, right? I think that might be an answer to your question. Oh, you were trying to be funny. I'm sorry, I missed the joke. That is cute. But that is an example, right? In general, you've been reinvesting it, and then you get to retirement, and rather than reinvesting it, you say, no, I'm going to let this accumulate in cash. And then each year I'll kind of look and see, okay, what did it generate in cash? And then kind of plan my spending needs over the year based on that. If there's no other questions, we can wrap it up. Thank you so much. We'll do another webinar next month, and we'll be sure to send the slides to everyone who attended here. Thank you for showing up. We appreciate it. And hope you guys have a great rest of your day. Bye.